Welcome back. We've got Devang Mehta also joining us this morning and to take stock of how things stand as we head into a fresh day, and particularly after the rout that we saw yesterday at Devang. We saw specific pockets also take the brunt of it. Auto, for instance, incredibly vulnerable, and it's a repeat of what we saw last year on that front at least. What would be your strategy when it comes to dealing with the current situation and the volatility? How would you advise one go about current holdings, particularly in pockets that are being impacted?
Hi, good morning, and thanks for having me on the show. Yes, clearly, I think market stayed resilient for a long while. In the last 2-3 months, we have seen for at least 4 or 5 times market correcting by anywhere between 1,000 to 2,000 points on the sensex. And why this is corrected? Because earlier, yes, the US yields came and played as a spoil sport. But so far, market has been resilient to any COVID fears or any COVID-led fears of lockdown. I think investors are right now worried about economic fallout of a fresh surge in these cases. Of course, there is an argument that vaccination is also happening in due course. Whether market takes heat from that the vaccination is going to probably destroy coronavirus faster than what it is anticipated at this point, that is what needs to be seen. But currently, I think the fallout is more on the sense that lockdown will happen in a lot of states, and again, that dreaded word called lockdown, which can probably hamper economic activity. And that's why the broader participation which was happening in the market, right from IT, pharma, FMCG, to even the sort of metals or banks and NBFCs, this wider participation can probably get hampered for a shorter period of time. And I think the assumptions of 11% of GDP and about 30% earnings growth for next year probably can get a little bit deterred at this point. So my sense is, yes, have a balanced portfolio, which we have been advocating. You should have ideally IT, pharma, the exporters, FMCG as defensives in the portfolio, and of course you need to have banks, insurance companies, and other stuff which are so-called Indianized in terms of your portfolio appeal.
Okay, we'll come back to financials in a moment, but on pharma names, DRL, of course, in focus because of the Sputnik V vaccine and the approval for that. Would that change your view in the near term on the stock, or do you feel that it's more of a momentary or near-term upside, perhaps not even complete clarity on the possible upside here, given the limited disclosures as per some brokerage views? What's your take on Dr. Reddy's?
I think, yes, probably the stock has underperformed if you look at the broader market, or if you also look at the pharma universe, where a number of companies like from Cipla to other companies in the Path Lab universe, all these companies have done well. I think it's again at that time of the year, last year, when a lot of pharma companies came to the fore and started to do well. You will get news thick and fast in between of sudden approvals for vaccines or some drugs. Also, the healthcare industry also probably, right from hospital stocks to your path labs to a lot of such pharma companies, niche pharma companies in the MNC universe like the Abbotts and the Sanofis and the Pfizers of the world, which have also underperformed in the last 3-4 months, where all the high beta stocks rallied. So I think it's time again where people will take a stock on the pharma stocks, and particularly for DRL as well. I think there is some bit of I guess soft stance which the market will take, and we can see a rally from here on.
Okay, Devang, TCS, not too much has changed in terms of a view, of course, moderate beat coming in, but what's your take on those numbers?
Clearly, the $9.2 billion order inflow for this quarter would be sort of given thumbs up by the market participants. And I think the company's earnings have clearly benefited from the surge in demand for the digital services and also migration to cloud over the last 12 months, which was triggered by, of course, the pandemic. And we saw how the IT companies initially reacted when the pandemic struck. But probably from the second quarter of FY21, I think large deal wins and client spending on cloud computing, artificial intelligence, Internet of Things, and shifting to digital, I think has helped all the IT companies, be it large cap, be it mid cap. So we certainly carry a positive view on TCS, Infosys, and other companies like L&T Technologies, which I think are going to benefit with productivity improvement being the central theme, and still work from home prevailing for some time to come.
On the auto names, Devang, I was trying to get your view on this earlier as well. Let's say specifically on the two-wheelers, we've heard out Rajiv Bajaj, and we'll play out some more excerpts of that conversation on how he feels the impact of this lockdown will be quite extreme. And we've already been seeing rising input costs, of course, and so on and so forth. So while latest numbers have been good in terms of sales, there is a huge anticipation that there will be quite a big hit on the segment. Let's take two-wheelers for now. What would you suggest going forward?
Yes, the scenario has changed in the past couple of months itself. So while we would be talking this in January or February, I think the times were such that probably people were just forgetting that the COVID is sort of has started to disappear. But it has raised its head again. And as I said, the dreaded word called lockdown, which again the business community probably will suffer a lot. And as such, earnings of the companies and the dynamics also change. As if there is a lockdown and the dealerships are closed, which we don't know right now, would it happen or no across in Maharashtra and also in other states. So if this happens, yes, there is going to be impact on sales. And as you rightly said, there are dynamics like earnings cost or rather input cost rise, which we have seen across the board. Though metal stocks are rallying, but rise in metal costs, rise in other commodities, I think also will come to hamper. And somewhere down the line, the inflationary pressure will come on earnings as well. And that's why it's imperative that one stays in the segment or stays in sectors where there are market leaders available. And that's why I think probably two-wheelers at this point, I'll have a little bit of negative view at this point, though there are companies like Eicher, which on a dip could be looked at.
Devang, just wanted to understand, given the tilt of the market towards metals, the fact that cyclicals are poised for a great Q4, and most of these stocks are still lucrative in terms of the kind of PE multiples that they're trading at, would you use declines like yesterday to buy into any of the metal names?
Asha, generally, we have been sort of advocating that, yes, for medium-term trades or somebody who is for a tactical bet in the market, yes, metal seems to be a good bet. But probably somebody with a little longer-term horizon, and that is where most of our client portfolios are placed. We clearly say that sort of avoid global cyclicals. There are a lot of opportunities in the market at this point. If I say not only IT, pharma, and FMCG, but if you look at overall as in healthcare as a theme, insurance, path labs, automation as a theme, capital goods, even Indian cyclicals, if I can mention something like a cement or even a building material type of paints, adhesives, there is going to be a lot of demand for this. I think there is also pricing power by a lot of these market leaders, which is going to be a very important word going forward. Whereas metals, yes, in the shorter term, they would have pricing power as demand has surged and it's a cyclical rally which they are going through. But I'm not very sure about the durable competitive advantage or the sustainable competitive advantage that the metal companies carry over the longer term. So I think stress-adjusted returns with a good night's sleep is more important in this setup rather than getting into metal stocks, which probably would sort of hurt you in the longer term.
Devang, what about real estate? I mean, yesterday, of course, we saw DLF down about 11, 12%, and we've seen the kind of rally across some of those real estate counters on the back of the kind of demand we've seen over the last year. But now things looking a little wobbly again. It's always been slightly susceptible to these, market shifts. What would be your view on some of the real estate names?
I think yes, real estate, we have always been advocating to play more via proxy plays. As you don't know, a lot of these companies are still having a lot of debt and project completions earlier were a big question. So yes, post-RERA, a lot of these organized players like Godrej Properties or Shobha Developers or even Oberoi Realty, a lot of these companies even based out of Mumbai have sort of gained not only market share, but also gained momentum in terms of their sales. You look at the news headlines talking about companies selling off their projects in 2 days, 3 days times, the first phase of the projects a lot of times. And I think the stamp duty cut in Maharashtra played a big role in the last few months. Yes, I think the safety would more be in, as I said, buying more of building material companies or housing finance companies rather, which are proxy plays. I think home sales would tend to still move up from here on. I think we saw a very bad cycle over the last 7-8 years. That cycle seems to be probably changing. So not bearish on real estate, but as I said, more of proxy play of real estate would serve the cause, which is, as I said, paint companies, adhesive companies, cement, other electrical goods. All such companies would sort of qualify, and also housing finance companies, which would be better candidates in terms of ROE, ROC than real estate companies themselves, which fall in terms of not carrying that great fundamentals, except for few companies which I mentioned.
Yesterday was all sectors. You had just a few from the healthcare universe that sprung a surprise. DRL, of course, had news attached to it as well. But BHEL, Indiabulls Housing, Tata Power, Z, DLF, these all cracked pretty hard. And I was just looking at some of the data as to the Nifty stocks, which have fallen almost about 20% from their 2021 highs. IndusInd Bank is now down 25% from its 2021 high. Coal India has lost about 23%. There's a Hero MotoCorp as well with a 23% move from its top. SBI as well has fallen 23%. Bajaj Finance, Maruti, M&M, ICICI Bank with a 21% fall. Axis as well has fallen hard. Eicher Motors, ONGC, Tata Motors. These are all stocks which have seen quite a bit of pressure come in from the top that they were sitting at earlier this year. But the space, Devang, that I want to address with you is TCS as well as Infosys. I know we talked about it earlier as well. But do you find that TCS, after its inline set of numbers, could react positively purely because of the data points that Kunal just highlighted, that it hasn't moved much as opposed to its peers in the last quarter or so?
I think, yes, clearly there was a valuation differential and the tug of war between Infosys and TCS in the last 5 years, where one of them acquires that market leading position and trades at a higher PE. TCS did it for a long time, and in fact, Infosys also did it in between. I think probably, yes, TCS has underperformed the broader market. We were also looking at some of the data points and also the IT index, where a lot of companies came to the fore and did very well. I think with this set of numbers, I think the consistency of TCS coming up with good numbers, plus, as I said, $9 billion of a win, which is the largest ever employee additions. Looking at the management commentary and the body language, I think they are in for a next year, which is going to be very good. And I think let's also think about the next 2-3 years for the IT industry, for IT automation, for digital services. All these companies who are in cloud computing, companies who are in artificial intelligence, they all will do well. So yes, TCS being a market leader, again, my vote will go for both TCS and Infosys. And one who does not have TCS in the portfolio should use any opportunity or a correction to accumulate TCS. Yes, this will not be a 25-30% type of a compounder, but it could compound at a 15 to 18% in your portfolio for the next 5 years, if not more.
Okay, fine. Financials, Devang, I understand that, financials continue to be, of course, an anchor when it comes to most portfolios. But given the vulnerability right now to the recovery and the kind of hit we always see, we saw this last year, we're seeing a repeat pattern already in the first couple of days of the knock coming in on some of those names. How would you perhaps, protect your portfolio somewhat? I mean, the heavyweights are of course, pretty insulated, perhaps to an extent, with a longer term view. When it comes to the mid-tier names, where we had started to see a lot of momentum building up, would the same apply there? Are you that bullish on the financials as an overall basket? What would you suggest?
Financials as a basket is a must-have in the portfolio. Yes, I fully agree on that. And in India, if you sort of are hunting for growth, financials has to be a part of portfolio. Again, whether you should be overweight or underweight or equal weight as in the index, that's again a call which needs to be taken as per the I can say the client profile, or in the sense that how much volatility one can absorb. And in such times, yes, we will see falls in financial companies, and rather banks or NBFCs, you will always see a fall. But yes, the mantra here lies in buying market leaders, and as you rightly said, companies like HDFC Bank or Kotak Bank, which have garnered market share during even COVID times. And somebody who wants to play the corporate capex, also there are no more proxy plays than Axis Bank or ICICI Bank. So I think this 4 banks should be looked at. Axis and ICICI will always be a little more volatile. HDFC Bank and Kotak Bank would offer you that sort of an insulated return. It comes with a sort of a caveat that this company companies grow, come what may. 18-20% growth is what they exhibit. So I think you can probably chase that type of returns when you buy this type of companies in a fall. Also, financials cover a wide range of companies. The consumer NBFCs, of course, would suffer at this point. But the sense here is that if this is short-lived, if the lockdowns are short-lived, again, this will bounce back. And what Bajaj Finance and Bajaj Finserv showed you last year was exemplary. That yes, we fall, but we rise when the markets rise, and we rise and how. So that is what I think when you buy this market leaders, you tend to buy it in tranches. That's the way to go about it because you don't know how uncertainty will prevail. And earnings season is also going to be probably playing a more of a role rather than anything else. So my sense is yes, buy good NBFCs. You can probably buy the large cap banks, private ones particularly, and insurance companies which have been our favorite. So lack of penetration, lack of density gives you a lot of impetus to keep in the portfolio companies like HDFC Life, ICICI Lombard, both general as well as life insurance as candidates should be part of the portfolios, and one should not miss the run on this for the next 5 years.
All right, Devang, we'll let you go on that note. Appreciate your time. Thanks so much for joining in.